Welcome back, ladies and gentlemen, dollars and cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. And in the last segment, we were putting some perspective on just how big the numbers are for the CARES Act. $2.3 trillion. That, folks, is a lot of money. And we think one of the biggest reasons why the market has been moving upward as much as it has. You say, Mike, what is he talking about? The market's been moving upward. Well, here's the numbers, because remember, the media only likes to exacerbate when the market goes down. They don't really talk about it that much when the market goes up. So at the worst point, not more than probably about 3 weeks or so ago, market was down 34% since the beginning of the year. This morning, again, taping the show on Thursday morning, the market is down just 15%. That's a big difference. And one of the things is the size of the CARES Act that really has helped the market kind of begin that recovery process. Not sure it's all behind us, because I think you've got some tough unemployment numbers and some tough earnings numbers for corporations to come out, but certainly interesting to see whether that low point that we're basically 20% above at this point will in fact hold. It'll be interesting to see that. But here's the point. The volatility in the market obviously cuts both ways, both down and up. And if you got out at the worst possible point here, you basically miss about a 20% improvement in your overall portfolio. That's pretty sizable. And unfortunately, we fear, as is typically the case, that that's exactly what most investors did. The flight to cash has been absolutely incredible during this period of time. The amount of physical cash in hand, jumped by nearly 2% for the week ended March 25th. That is the biggest weekly increase since December of 1999. December of 1999. That's back when we were all concerned about Y2K. Remember that? I mean, it's amazing how, how the concerns of 20 years ago look kind of silly, but at the time, I remember it well, we were quite concerned about the complete collapse of anything computer related. I mean, there was even some speculation that you would have planes falling out of the sky because of just how much of a problem Y2K was going to be. So everybody hit up the ATM, and there was a massive jump in physical cash in circulation. We saw that exact same thing play out just recently for the week ended March 25th. Meanwhile, demand account balances, checking and saving, increased by 16%, which was the most in 9 years and the biggest weekly increase since the U.S. credit was downgraded from AAA. Remember that? Back in the summer of 2011. At that point in time, there was similarly a really big increase in the amount of money that was in cash and demand accounts. And the backdrop of all of that is incredibly low interest rates. So go back to the comparison of the CARES Act that we were talking about earlier in the program. $2.3 trillion. It's funded entirely by issuing new 30-year bonds. Those bonds, as of March 31, issued at an interest rate of 1.35%. If the U.S. Treasury is issuing 30-year Treasury bonds at 1.35%, that's why you're getting nothing to hold on to cash. Because if the U.S. government can go to the marketplace and say, hey, we want to borrow money for the next 30 years, and you know what? We'll pay you the handsome sum of 1.35% per year for the next 30 years. That's pretty cheap money. And so consequently, sitting in cash means that you're making like even less, if it was possible, even less than what you were making previously. This to put it into perspective, okay? And that's the low interest rates is one of the reasons why the folks in Washington went as big as they did on this. So to put it into perspective, an annual debt service on $2.3 trillion amounts to $31 billion a year. Again, that's a huge number. We're not saying, okay, that it's not a burden. It is. 31 billion a year is, but just understand the perspective. At 1.35%, your annual debt service on 2.3 trillion amounts to $31 billion a year. During the year 2019, US government had outlays, meaning they spent over 12 billion per day. So basically, the interest cost, the carry cost on the 2.3 trillion is the equivalent to what the US spends in 2.5 days. Stop and think about that for just a second. It is a huge number. It's a big amount of money. No question at all. Do I worry about it for future generations? Absolutely. Absolutely. At some point, we've got to reckon the ridiculous amount of money that this country owes. But in terms of where interest rates are, in terms of the fact that the U.S. Treasury can finance a $2.3 trillion stimulus package by issuing out 30-year treasuries at 1.35%, that's amazing. The only reason why this is this crisis, or in the market response of late, has been what it is because that's an incredibly low carry cost. Your carry cost on $2.3 trillion is $31 billion a year. That's the equivalent of what the U.S. spends in 2.5 days. So that's why they've gone as big as they are. It's kind of incredible when you stop and think about it. And these low interest rates and so much cash, I mean, people forget the history and how quickly the recovery can be. I mean, this most recent market decline marks the 12th bear market since the end of World War II. The average return for the S&P 500 in the first year following the low point of the bear market is 39%. Folks, when you ask the question, I lost money, I don't think I'm ever going to recover it, check your history books. Check your history books. The market recovers very, very quickly. And we forget about that because no one really ever talks about it. That's why we're talking about it on the program this morning. From the bear market low, in the 12 bear markets since World War II, from the bear market low, the return over the next year on average up 39%. Folks, I don't know about you, but up 39% repairs a lot of the damage from whatever a bear market did in an investment portfolio. Again, right now, market was down 34% as of March the 23rd. It's now down only 15% since year to date. That's how quickly it can shift. So when we're talking about the numbers and what's the impact and how soon am I going to recover, which is the question that everybody's asking, just take a look at a little bit of history. That might very well help to provide some perspective and keep some things in mind and allow you to wind up being much more consistent on your investment strategy. The answer to the question is of how soon will I recover? Of course, nobody knows the future, but the reality is you just look at history and you can get a pretty good feel that, hey, you know what? The market moves quickly both up and down. And so those are the important things to remember. And certainly in terms of those statistics, some pretty amazing statistics, particularly when you think of it relative to how much the stimulus package was under the CARES Act and what the current interest rate environment is. It is shocking, though, the fact that everybody rushes to cash during a period of time like this, and ultimately you're making absolutely nothing. And if you thought you were making a low amount of interest rate on your cash accounts, it's much lower now than it was just a few months ago. So anyway, next up, we're going to talk about one of the most sobering statistics throughout this whole COVID experience that we're in the middle of. One of the most sobering statistics. So we'll tackle that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando.